Is China finally coming back? That's the question that we're going to be asking ourselves today on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. It's somewhat of a quiet day for macro news today, but we do have an opportunity. And that is to look at the world's second largest economy, especially in the wake of some troubling U.S. growth indications that we saw Friday, and which still are reverberating through the stock and bond markets. Stocks again down today, bonds surging as yields fall, ostensibly around growth concerns. It is an opportune time, seemingly, to ask the question, will we get a rescue from the world's number two biggest market? Because, of course, the essence of the concern, as ever, is that the U.S. slowing leaves no backstop, with China being weak and the Eurozone at a standstill. But there is perhaps some indication that China is on the way to some sort of a recovery, at least if you ask some financial markets. And so it bears exploring the question and seeing what is actually going on here. So what we're going to do is take a look at what these markets are saying, take a look at why they might be saying it, and whether this means that finally there is some bottom fishing to do, or if perhaps this is, again, a false start for China, as we have seen so frequently over the past 2 years. So let's have a look at what is going on here. And this is a weekly chart, so each one of these bars is a week, and you can see that since the beginning of the year, FXI, the iShares ETF that tracks large cap Chinese stock names, has been surging. Now, obviously, the tempting thing here is to look at DeepSeek. A lot of this breakout here seems to line up with the unveiling of the DeepSeek AI model and seems to raise the idea that maybe now in China we're looking at a real competitive AI landscape, which was previously dominated, of course, by the U.S. And of course, we've gone back and forth on whether the news really means that China is in earnest competing at U.S. scale, or if this is more something that isn't necessarily country specific, but more so directionally specific for AI as an industry. But it is unmistakable that this gauge of Chinese equity market strength is very healthy looking, and notably takes us back to these spike highs from late last year, where there was a sense that perhaps the officialdom in Beijing is getting serious about fiscal stimulus. Of course, the markets have been pining for China to do some amount of fiscal support to revive the economy, which hasn't really seen any growth since emerging from zero COVID restrictions in late 2022. And when we got some initial hinting that maybe finally Xi Jinping and company are ready to spend some money to get things kick-started, there was this spike. It was, of course, let down because the stimulus never really arrived as the markets hoped it would. But we, nevertheless, are back at these highs, which suggests that maybe they're finally looking at this, and again, maybe motivated by the DeepSeek news, to think perhaps something is on the mend here. Perhaps things have become too cheap and now it's finally time to bargain hunt. But before we get overly excited, let's take a look at this more broad index of Chinese stocks. Again, this is a weekly chart. Here's that same spike around those hopes for stimulus. But The ASHR ETF, which tracks the onshore CSI 300 index, those are the top names listed in Shanghai and Shenzhen, that essentially amounts to China's version of the S&P 500, a kind of broad-based index. That's not doing nearly what FXI, the large cap index ETF, is doing. So what's going on here? Are we really seeing signs of optimism? I mean, this is clearly up a little bit, but it's still very much near the middle of a range that's persisted here for the better part of 5 months. So are we in fact seeing recovery, or is there something else going on under the hood that is misleading? So we're going to unpack it here and figure out if in fact there's a trade here and in which direction that trade might lead. So first, the baseline economic data. Shock of shocks, it remains abysmal. So this is a chart that we've been looking at for quite some time. This is Chinese real and nominal GDP growth, and this really captures the essence of the problem in China. In the red is real GDP growth. That's growth minus the impact of inflation. So the way GDP is counted is you look at the sum of all goods and services produced in a country, but when you sum them up, some of your aggregate is just a change in prices from one period to the next, and that's not real growth. So you want to take that away to get a sense of how much output actually is growing, and the value of that output is growing outside of changes in prices. So that's what real GDP is. Nominal GDP is simply the easier version of the calculation without the price adjustment, just the adding up of the value of all goods and services output. That's in the yellow. Both of these are year-on-year rates, and what you see is that since early 2023, and now for 7 consecutive quarters, real GDP growth is running above nominal GDP growth. What that's telling you is that to get from nominal GDP to real GDP, you have to subtract from nominal GDP a negative number. How else would you be able to get from lower nominal GDP to higher real GDP by subtracting inflation? Well, you'd have to be subtracting negative inflation. And so what you're being told when you look at this is that at an economy-wide level, you have deflation in China. And what that implies, of course, is an absolute lack of demand. What typically happens when there's positive economic growth and people want to buy stuff is a situation where as the demand meets whatever supply is there, if the demand is robust, it outstrips supply, at least for some period of time, and prices go up. If prices are going down, which is what this is telling us, especially at an economy-wide level, that's the opposite. That's the opposite of having demand drive prices up. This is the absence of demand putting everything on discount. Essentially, the entirety of the world's second largest economy has been relegated to the bargain bin. And so what this tells you is there's not much demand to go around. The economy is weak. That this has been happening for 7 consecutive quarters now, of course, is incredibly ominous. Moreover, it's gotten worse in the fourth quarter of last year, which is the latest data that we have here. It's back to the worst that it's been since 3 quarters ago, at about 78 basis points, or 0.78 percentage points of GDP. So not good news at the headline. If we look at the latest CPI and PPI numbers for something a little bit more actionable, obviously GDP numbers are a little bit lagged, the story isn't much better. Consumer prices are still hugging zero, only a touch higher. In fact, they haven't been above 1% in close to 2 years. Wholesale inflation still below zero, still deflationary, and telling you that there isn't a perking up of demand in the pipeline. Still, obviously, weakness there. So the higher frequency data not showing us signs of improvement. If we take a look at what's going on with the latest PMI numbers, this is, of course, a very good approximation for GDP and a timelier one of where things are going. We can see that from the start of this year, so far we only have January data, February numbers come next week, we see here that, if anything, we've been stalled since the reopening, essentially just spinning our wheels on manufacturing and service sector activity growth. As ever, these numbers are presented as a diffusion index around 50, where 50 right here is neutral, neither growth nor expansion. And above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. These numbers are official government numbers from CFLP, the China Logistics and Purchasing arm, and made in conjunction with NBS, the National Bureau of Statistics. So this is the government's numbers. And what you find here is they're telling you, basically, since the reopening, this is the reopening from COVID restrictions right here. You can see service sectors activity, not surprisingly, jumps as people are let out of lockdowns. But as we then get through the rest of 2023, things cool. And by the time we get into the fourth quarter of that year, we get into a kind of range that has held since, without really any scope for meaningful liftoff. And if anything, at the beginning of this year, things have become weaker. Service sector near standstill, just a hair above 50. Manufacturing contracting again. If we look at a private sector version of these numbers, this one made by the media company Caixin in association with S&P Global, ironically, these numbers are a touch better than official figures, which is a bit unusual for China. There's at least a perceived tendency for Beijing officialdom to want to shade the numbers to the rosier side. But the official numbers are actually weaker here than these. But the story is the same. Since the fourth quarter of 2023, standstill. Since the start of 2025, weakening within the range. So not good news on growth. One bright spot has been a little bit of a pickup in exports growth. We can see that they've been a little bit better recently, but of course, as we just saw from U.S. PMI numbers, it's been a pickup in U.S. manufacturing around the front running of tariffs. And of course, this is very much a part of that story. In fact, this started to show up even earlier than the pickup in U.S. manufacturing. After November's election in the U.S., of course, there was the expectation that there would be some amount of escalation in the trade war, given the incoming administration's penchant for such things and their stated desire to get tougher on China. So, not surprisingly, U.S.-based importers that would have to pay the tariffs attempted to buy as much as they can from China before the tariffs hit. And things got more expensive. So there has been a pickup in this side of things. But if we look at imports as a gauge of domestic demand, that's only weakened since about mid-year. The trend here, lower. These have diverged. And so what you're looking at, still not especially encouraging for domestic demand in China, and much as S&P Global argued when they talked about the front running of tariffs in the latest U.S. PMI report, any lift from such dynamics is inherently temporary, so the uplift in exports here probably short-lived. The housing market, which has been the essence of reluctance for Chinese consumers, because it is by far the dominant vehicle for investment and where people's savings have tended to go. That's not looking any better either across a whole range of indicators of China's real estate market, the main takeaway here is everything is below zero. The year-on-year rates for funds in place for real estate development enterprises, the floor area of commercial housing sold, floor area of buildings completed, buildings under construction, newly started buildings, investment in real estate development, all of these year-on-year rates across all of these indicators of housing market strength, all of them have been going down since 2021, and all of them are still below zero. So deterioration continues across the board. Not surprisingly, if we look at a willingness to spend from Chinese consumers, we find that since the pandemic, there was a rapid acceleration in money held in time deposits, that is, longer-term deposits, call it savings deposits, as opposed to checking accounts for a simple analog. Demand deposits are money that's available to spend right here, right now. Time deposits, less so. And when money is coming out of time deposits and going into demand deposits, that's typically a gauge of people becoming more optimistic and readier to part with their money, be it for consumption or investment or whatever else. And you see that since COVID, Chinese households have been exceedingly defensive. So the ratio of time deposits relative to demand deposits has significantly increased. Moreover, you can see it here just with the naked eye, the slope of the time deposits data here, much steeper than what's going on with demand deposits. And you can see that while there was a relatively well-constructed range on this, and it wasn't really going very far until COVID, it has since turned much more defensive, and this trend hasn't changed. Do keep in mind this little wiggle, though, this little wiggle lower, because it might be part of a larger story. What this does certainly suggest is that whatever was holding back Chinese consumption, that is to say, what was keeping these imports going lower, what was keeping consumer prices anchored, what was keeping the economy without demand, that's still very much in place. Moreover, to add insult to injury, the stimulus that China has offered up hasn't worked. This is the Bloomberg Credit Impulse Index. It measures the share of new loans in GDP. We have the overall index here. As we can see, it's been going the wrong way for quite a while here. But moreover, the year-on-year rate in the index has actually accelerated in the wrong direction. Up until January, where we can see there was a slight reprieve. So not only are credit shares in GDP not improving despite a raft of monetary easing, from rate cuts to better mortgage terms, to better terms for regional governments to pay down their debts, to handouts to buy stocks, all of this liquidity being made available, lower bank reserve requirements, on and on and on. All this monetary easing. For all of it, not only is the share of new credit not growing as a part of GDP, it's actually shrinking at an accelerating rate overall since the beginning of last year. So the economy still looks very, very weak, and the stimulus on offer is doing very little to change that. So what is going on with these Hong Kong stocks? What is this all about? And looking at fund flows seems to tell the story. Now, there is a setup in China called the Hong Kong Stock Connect, which allows people with access to Hong Kong markets to trade securities directly on the mainland in Shanghai and Shenzhen, and for people on mainland in Shanghai and Shenzhen, and with that market access, to trade securities directly in Hong Kong. And looking at southbound versus northbound capital flows can be very telling, southbound as in from the mainland toward Hong Kong, northbound from Hong Kong to the mainland. That can really tell you a lot about what investors are thinking and whether there is real turnover and real volume behind some of these moves. So consider in the red here is the Hang Seng Index, the Hong Kong stock benchmark. Notice it looks just like FXI, and of course it does, because FXI is tracking these large cap names, but they're all Hong Kong listed. There's no mainland stocks in this ETF. Whereas China's mainland index, as we saw here, still very much anemic. So what's going on with Hong Kong? Well, clearly there's a pickup in net inflows going southbound from mainland to Hong Kong. Clearly there's a level of activity here, and perhaps that explains how you have this sharp pickup, not only in FXI, but of course in the underlying Hong Kong index. But look northbound. Money going from Hong Kong and ostensibly from foreign investors via Hong Kong into the mainland, and you do not see it. This is hardly a picture suggesting that what you have is optimism about China's recovery, because foreign money isn't going to the mainland. Hong Kong is not seeing capital move toward mainland markets, which is why they're so anemic. Instead, you have money leaving China and going toward Hong Kong. Now, what that might rhyme with here is this: money moving out of time deposits into demand deposits, perhaps with the goal of an escape valve via Hong Kong. Certainly wouldn't be the first time. So if anything, what this pickup in Hong Kong might indicate isn't that things in China are improving, but rather that money is becoming even more spooked and is trying to leave the mainland financial system entirely. We've of course already seen an absolute flood through the exits for foreign direct investment, but this would suggest that the pickup in Hong Kong stocks speaks not to optimism, but perhaps even to pessimism about what the world's second largest economy is doing. And in that, the threat of global recession around a U.S. slowdown without a recovery in China and with an anemic Europe looks that much more acute. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones today, Tuesday, for the price of truth, just 30 minutes from now, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.